Thank you everyone for waiting right to the end. I'll try very hard to make it worth your while. So my name is Simon Barnard. I'm the fund manager of the Smithson Investment Trust. I've been a professional investor for 20 years, but I've been managing the Smithson Investment Trust since its launch in 2018. You can read that probably at the end. It just means that if you buy it and it goes wrong, it's your problem, not mine. So what is the proposition if you buy shares in the investment trust? Well, we are providing you access to a concentrated portfolio of the world's best compounding small companies. And that's quite unique in a couple of ways. Number one, a very concentrated portfolio of smaller companies. Very rare in the investment world. We have a portfolio of about 32. I hardly ever see many small cap portfolios below 100. And the second point is we only buy very good companies that have proven to be the case because we want to own these small companies, allow them to compound until they become very large companies. And you can only do that by buying small, profitable, growing companies that can sustain both the profitability and the growth. Why do we think this is a good idea? Two quotes from the master himself, Warren Buffett. First of all, he says, I like to put meaningful amounts of money in just a few things. And second, he's constantly bemoaning, if anybody follows what he writes and what he says, constantly bemoaning the fact that Berkshire Hathaway is now so large that he has to wait around for enormous deals. And often when people say, what would you do or be able to do if you were starting again? He said, I would buy small companies because it may be that the elephants we are forced to buy are not as attractive as the mosquitoes that are out there. So for those two reasons, we think this is a fairly good idea. How do we go about it? Well, it's very simple. First of all, we buy good companies. It's been a bit cut off there. Second, we don't overpay. And third, we do nothing. All this means is that we sit on these assets and allow them to compound into much larger companies. We've had several examples of how we've done that. But what we practically do day to day is that myself and my team scour the world for the best companies that we can find in a few sectors, and we're going to go through that in a moment. And we maintain a long list. We found about, as we talk, around 90 companies that are worth following. So these are the 90 companies we call our investable universe, the 90 companies that we think are good enough to one day own in the portfolio. Now, as I mentioned, our portfolio is around 30 names. So the key difference between that 90 long list that we have curated and found and spent 7-8 years searching for, and the 30 in the portfolio is primarily valuation. Good companies are quite obviously good companies and very frequently come with a valuation that means that they don't become particularly good investments. You've got to pay the right price for a good company to be a good long-term investment. So a lot of the difference between the 90 long list and the 30 portfolio is valuation, which is why it's the second point there. But also there are different stages of business cycle. Even though we invest in good companies that have a degree of cyclicality, we try to make sure that those companies are not loss-making at the trough of their cycle. But still within those 90, there'll be a whole range of businesses at different parts of their business cycle, and you don't clearly want to be owning them all the way down to the bottom, and you clearly don't want to be buying them right at the top. So again, within that 90, there is a mix of businesses where the timing isn't quite right. But other than that, once we've found the company that we like, we get the opportunity to buy it at a great price, then we just sit on it and try to do as little as possible. So what do I mean by good companies, and which areas do we look for? Well, when we look at the MSCI GICS sectors, so this is the standard sectors set out by MSCI, the index company, we traditionally would therefore focus in consumer, in industrials, in technology, and in healthcare. But those are very broad sector descriptions, and really, even a lot of those we don't look at. We are very, very prescriptive on the types of companies we're looking for, the types of metrics we need to see, and therefore the types of industries that they tend to come from. For example, you'll notice that I'll never talk about energy very cyclical industry with a commodity base that the companies have no control over. We don't talk about utilities, highly regulated, or telecoms for the same reason. We don't talk about real estate, which is highly levered. On average, our companies are net cash. So there are swathes of the market that we just don't bother looking at because it has been shown through decades, if not over 100 years, that these are not sectors that generate strong shareholder returns over long periods of time. But the sectors that we do focus on very much do have that track record. And within that, we focus even more specifically. So I've given some examples here of niche areas within those broader sectors that we find very interesting. The top one in consumer, I've given a few examples. Maybe I'll just start with Oddity. This is a fascinating company because it is ultimately taking on cosmetic giants in an area they don't wish to play. So Oddity is an online business listed in the US, selling cosmetics under their own brand, which they design and develop and sell directly to consumers online, and it is a very difficult business to do. The giants in the industry are obviously L'Oreal, Estée Lauder. They have not bothered to try to sell cosmetics online to new customers. They sell plenty of refills to existing customers who know what they want. But imagine trying to sell cosmetics online to a new customer when they want to feel the product, test it on their skin, see how the shade matches them, understand how to apply it at home. It's very, very hard. The way that Oddity did it is they set out as a data company and created algorithms around that to apply it to cosmetics and online sales. Put that into numbers. They tell us that they have over 40 million customers on their database, active users. They have over 2 billion data points on those customers, and that they are able to sell to a new customer with a 90% hit rate. So the customer goes on the website, I've done it, so is my partner, log in, they take their quiz, they somehow manage to garner 50 data points from you without you even realizing, and then they just tell you this is the product. No choice, this is the one that you're going to buy. I bought it, put it on the skin, it's a perfect match. But obviously this is being used with AI, data algorithms. And that 90% hit rate, by the way, is better than a Sephora in the US or Boots in the UK when someone walks into the store and is helped by a beauty expert. They only achieve an 80% hit rate. The computers are already beating the in-person appointments. And so the great irony of all this is L'Oreal, Estée Lauder, these are 100-year-old companies. At their latest investor days, they said they were very happy to have over 10,000 consumers on their database for online sales. I'll remind you, Oddity has 40 million. It's a different playing field. Data services is another one. We're talking a lot about AI tonight. We had a fantastic presentation at the start all about AI. It permeates its way even into smaller companies. So Reply, for example, is an IT consultancy based in Italy, growing very quickly, roughly 18 to 20% a year, because they are employed by their large corporate clients to deploy AI technology into those technology systems. The beauty of this model, of course, is that whoever wins the AI race, I don't have to decide, they don't have to decide. They just deploy the best technology whenever it is available. So they win whoever wins. Then moving on to software. Obviously, software is a key part of the very profitable, growing small company space. We've got several examples in the portfolio. All of these names are in the portfolio. We've got several examples in software. Qualys, cybersecurity, couldn't agree more with the first presenter. That is especially an area that we are excited about. And in fact, we've just sold a cybersecurity company because it got too big for us. This was a company that we bought back in 2020. The company is up over 500%, and we sold it when it was approaching 70 billion in market cap. No longer fits in small cap strategy, but we had fun while it lasted. Qualys is also cybersecurity in a slightly different area. Serial acquirers, this is quite specific and something that we have been focused on since inception, to the extent that Diploma, having started out as a small position in the portfolio, is now by far our biggest position. This is a company that's grown at 25% every year over the last 5 years. It is now up, I think, 450% since we owned it. And the way that it does this is it is a very focused industrial company. It's a distributor of specialist machine parts for several different industries, all of which are growth industries. But the way that Diploma itself grows, because its organic growth is not that exciting, probably mid-single digits, depending on industrial production. But it runs a very decentralized structure. So it's actually not dissimilar to a mini Berkshire Hathaway. We talked about Warren Buffett right at the start. It has a tiny head office and about 50 subsidiaries, and it allows the MDs of those subsidiaries essentially free rein in growing their individual businesses. It just provides the capital to do so. So each of these individual 50 subsidiaries are constantly acquiring other smaller companies in the 5, 10, 20 million range. And so the company is therefore able, even with a modest organic growth, to augment that to becoming, as I said, above 20% growth a year. And the best bit about this, it's unlimited. Unlike putting up price on your customers and doing a bit of volume growth, which you'll always reach a price headline level ceiling. If you keep adding tiny companies to your business, you can basically go on forever. Until, of course, you become the size of Berkshire, in which case we'd be happy to move on. Quality Industrials, this goes across the world. Again, Monotaro is a Japanese company. Others that I've mentioned have been US, Italian, German, and English. Monotaro is based in Japan. This is another online business, actually, but more towards the industrial space. They sell maintenance, repair, and operational equipment to Japanese corporates. But the unique aspect is Japan isn't particularly online in this industry. So the whole online part of the MRO industry is only 20% of the market. Monotaro is by far the biggest online player. So as that market moves online, which it consistently does year after year, Monotaro gains all of the additional growth because they are the one-stop shop, the go-to player. They have the broadest number of SKUs, they have the biggest internet presence. And so whenever anyone in Japan searches for MRO stuff online, they're the ones that come up. They accrue all of the incremental growth. So they're growing 15 to 20%, even though MRO business isn't that exciting. And then finally, healthcare. We've got a few different examples here. Fisher & Paykel's in New Zealand. MedPace is a biotech-exposed company in the US. But Doximity is probably our most exciting company. We only bought this in January. The stock's already up 40%, which is pure luck. But it's because this is a US-based social network for doctors. So when a doctor signs up to the network, they have to put in all their credentials. Instantly, Doximity knows everything that they are interested in, all of their research that they've ever published, and therefore they essentially give them a feed of only items, articles, and adverts that are of direct relevance and interest to them. And as they scroll through the feed, every so often, and I mean only once per month per advertiser, do they actually get an advert in the form of an article written by a pharmaceutical company. So many doctors that are interviewed on their use of Doximity don't even realize that they are being advertised to. They're simply reading another article in their feed. But of course, for advertisers, this is gold dust. They are able to precisely target individuals in their specialism for their drug. And of course, they're willing to pay for that. Doximity is growing revenues at about 50% and earnings at 90% over the last 5 years per annum. So we say we buy good companies. How do we even prove this to you? Well, we can. Our most shorthand measure of quality would be return on invested capital. I laud the prior presenters on their disclosure of their return on capital employed, because not every company does so. It is a very, very important measure. And our portfolio, on average, you can see this in the middle column, has 26% return on invested capital. That is a high number. I can assure you that because our reference index, the MSCI Small and Mid Cap Index, the average company in that index has only 8% return on invested capital. And by the way, we're not even including our highest return company because it is so high return that it skews the numbers to a degree that I didn't feel comfortable representing to you. So this is every other company except for that one. And that, of course, is made up with very strong operating metrics beneath. The operating profit margin on average for our companies is 25%, whereas the index is 8%. Cash conversion, we focus on cash. We don't care about accounting earnings. We only look at cash, which is why our companies are so cash generative that we have, on average, above 100% cash conversion. And then finally, we couldn't put a leverage metric in here because, as I said earlier, our companies are net cash. Instead, therefore, we put an interest cover just to demonstrate, but I think it's pretty clear that our companies are much more conservatively financed than the average in the index. And then the final and potentially most important point is growth. Our small companies will only become very big companies if they can grow for a long time at a high rate. And on average, our companies last year grew their free cash flow at 22%, which, if you compound, that gets to a very high number. In fact, I'm being slightly disingenuous. The weighted average growth rate was 44%, but it sounds almost unbelievable. I give you the median, so halfway down the selection of our companies is 22%. It's the company number I feel much more comfortable you anchoring on. I wouldn't count on the 44% recurring. A lot of our companies are recovering their cash flow post-pandemic. But since inception, over 7 years, has incorporated a lot of bumpy years. And I can tell you that on average, over all of those years, our companies have grown their earnings at around 12% and their free cash flow at about 15%. So that is the up years and the down years all included. Then getting to why would you even think about investing in small caps now? Well, interestingly, small caps have been quite out of favor. We discussed right at the start of the evening the concentration in the market in the Mag 7. Well, it actually goes further than that. All of the performance has been in large cap, not just the Mag 7 and technology. Any large cap has done better than small cap. In fact, over the last 5 years, they have outperformed small cap by over 50%. So you can see here that this is the relative performance of our reference index, the MSCI World SMID Cap, relative to the large cap version. And as the line goes up, it means SMID cap is outperforming. Now, 99-2000 was the peak of the last large cap cycle, the trough of the small cap relative cycle. You had a fantastic 15 to 18 years. And then from 2018, coinciding roughly with when we started the fund, of course, small and mid caps have been underperforming large caps quite consistently over the last 7 years, which ultimately means that over this period, when we look at valuations, the valuation of the small and mid caps, so below this horizontal line, means small and mid caps are at a discount to large caps and vice versa. You can see that in the prior cycle, small and mid cap valuations troughed around the dot-com bubble of 2000, which makes complete sense. And we are almost approaching back to those levels today after the several years of consistent relative underperformance of small cap versus large cap. Now, the final and most important thing you should be asking anyone that stands in front of you offering you a proposition like this is, does it work? The answer is yes. So over the years since inception, we have compounded ahead of the reference index. We have only had one down year. But I have to tell you that small cap investing isn't for everybody, okay? It is a volatile asset class. It is more volatile than large cap. And you have to accept that fact. You can see that we've had years, more than one, where we've been up over 30%. We've also had one down year where we've been down over 20%. You know, this is not for the faint of heart. It's a concentrated portfolio of very high quality companies, but it does move around. But over the piece, you should be left with a good result. On the bottom chart, you can see that we have also outperformed our small cap investment peers. So with that, I'll leave it for Q&A.
Thank you very much, Simon. Thank you. Have you got any questions in the room, please? Atel? you said you had a question.
Yeah. So Simon, I'll ask you a question. What's the sort of range in the prices you buy companies at in the market globally?
As in the size or the valuation?
The valuation, please.
Well, it's a broad range because it depends what you're getting. Price is just a number. It all depends on the value that you receive for what you're paying. And for us, we have a whole range of types of companies in the portfolio. We have companies that are growing less quickly but are very stable, like Clorox, a consumer staples company. For that, we're paying quite a low rating. So in free cash flow terms, it would be 5% free cash flow yield. In PE terms, it would be around 15 times. On the flip side, Doximity, I just mentioned, our fastest growing company, you'd be paying a much higher rating, obviously. So for that, we'd be paying about a 2% free cash flow yield and about 40 times earnings.
Just one more. At the moment, you're trading at a 10% discount. Can you explain that and what you might be doing over the next year or so to try to change it?
Yeah, well, since inception, we were trading at a premium right up until 2022, when there was, obviously, we had the change in the investment interest rate cycle, and so that investment environment changed quite dramatically, both for our companies, the ratings were compressed, and also the investment trust sector, which is the first time that we dropped to a discount. We are still on a discount of around 10%, and the board have taken this very seriously. So this is basically now the number one factor that is discussed in board meetings, and it is one that they are very determined to eradicate. And to do so, they are quite aggressively, I would say, buying back shares in the trust. Over the last 2.5 years, they bought back over 28% of the company, and they will continue to do so until they see that discount narrow.
Okay, question at the back.
Thanks for the presentation, Simon. So with the Trump administration, obviously you've got the potential headwinds of a recession for for small businesses and what that means. But on the other side, the tailwinds of perhaps a re-rating for the large cap companies in the S&P. What does that look like in terms of the opportunity or the risks moving forward?
There's a lot of risk. The biggest risk with the Trump administration so far is uncertainty. No one knows what the hell is going on. He changes the tariff rate every 3 days, and ultimately what that means, and I heard another presenter say earlier, people are too cautious about signing on the dotted line. So where they may require to spend the capex, and certainly when they look out into the future that will be required, they're hesitant to do so when they are not entirely sure the best location for that capex to be employed. Because, 2 years ago they were happy to put it into Mexico, now it's the last place they're going to think of doing it. So everybody wants to work out where is the least risky region to deploy that capex before actually doing so. And when there is no one investing globally, it's a much more difficult place for us as investors to calculate where to invest in next.
All right.
Thank you.
I was going to ask a question as well. Is it true to say that you're pivoting away from the US and going to focus more on Europe?
Not quite true. We have about half the portfolio in the US.
Yeah. But will you going down the line this year?
I would say we'd roughly maintain that only because we have, that is still a substantial underweight relative to our reference index. Now, having such a concentrated portfolio, our reference index is not something that we pay particular attention to in terms of portfolio construction. But it is helpful to demonstrate that when we have 50% of our portfolio in the US, but the global markets are represented to the degree of 62% to the US, when the US underperforms, as it has done over the last 3 months, we are very strong beneficiaries of that.
Right. Just out of interest, you sold Fevertree.
Yes.
Was it what particular reason for doing that? It doesn't seem a bad
it's not
company. I mean, it has its ups and downs, but it's a solid.
It's not a terrible company. Okay. This could be a long answer, but I'll make it a short one. They have recently done a deal in the US with Molson Coors. Now, the US is their largest and fastest growing business. It is also their least profitable, potentially loss-making market. Their UK is their second biggest business, the most mature, the highest profitable, but is going backwards. So when things are doing badly, and Fevertree is not doing very well at the moment, the question you should constantly ask yourself is this a cyclical issue? Will it rebound? Or is it a structural issue? And we're just watching it tail off into the distance. So for us, thinking carefully about where the group as a whole was going, their most profitable market going backwards, their biggest and fastest growing business being loss-making, but with a lot of potential. And then they sign this deal with Molson Coors, which essentially caps the profitability in that business. It takes a lot of the upside away from that fastest growing large market. And so when we did the maths, it showed to us that they may never again reach the margins that they had done prior. And so for us, the valuation, which by the way wasn't low, no longer made sense.
Okay, thank you. Got time for one more question? Anybody in the room? Or is that it? Yeah? Oh, there's one here. There we go.
It's kind of on the same topic, because you mentioned that we're selling companies when they get too big for the portfolio because you're focusing small, and the examples you've just given there with Fevertree. I wonder, could you give us a bit more of a view, and when you're looking at your list that we've got in the portfolio and then comparing to the long list, at what point or what are the key things that you look for to say, now is the time to sell out of this and there's a better opportunity elsewhere?
Three things. The first is obviously valuation. So I've commented a couple of times, small caps are a volatile asset class, which can be a good and a bad thing. A good thing if the prices move around to, one, give us the opportunity to buy it. We've had several examples where these are great quality companies at a too high a price for us to consider, but something happens to them. We call it a glitch. Actually, we've had two situations where it's been a cyber attack, and it's been big enough to disable the business for a short period of time. We bought two companies that way. One was Equifax, one was Clorox. Both rebounded subsequently. So that is one good time to buy into a company. But your question on selling, the volatility in the share prices obviously also leads to extremely high valuations. So last year, for example, we sold a software company based in Australia called Technology One, simply because during our period of ownership, it'd gone up about 500% and had reached a valuation of less than 1% free cash flow yield. Translated, that's about 80 to 90 times PE, and it had just simply become too rich for us. So that was one reason to sell. The second reason, small caps tend to have management teams that are quite often founder-led. We have many. And they are very powerful within the company and can shift capital allocation within that company very quickly and sharply. We've had a couple of situations where that's happened. We didn't agree with the new direction, so we sold. And then finally, small cap companies are more niche in their business, either in their region or their product line, which means that things can go right or wrong in those niches quite quickly. Again, if we own a company which is not diversified outside of other niches, and that particular niche we observe either going into a multi-year down cycle, or in one case we had a company making high-powered lasers where Chinese competition was coming in very aggressively, then we'll have to sell because that niche is no longer attractive.
Excellent. Okay, that's it then. Thank you very much indeed for the presentation. Thank you.